When you think about owning gold, what's the first thing that comes to mind? For most of us, it's buying a coin or a bar, sticking it in a safe, and, well, just hoping the price goes up. But what if that's the completely wrong way to look at it? What if, instead of treating gold like a shiny rock to hoard, you could treat it like a business you can actually run? Today, we're going to flip the script and dive into how the pros turn an asset like gold from a simple bet into a machine that can generate consistent cash flow.
And this, right here, is the question that really separates the average investor from the professionals. You see, most people are stuck on a one-way street. If gold's price doesn't go up, they make zero. Actually, it's worse than zero, because when you factor in inflation and storage costs, they're losing money. But the pros? They've figured out how to get paid regardless of what the market does. Up, down, or even if it goes completely sideways. So how on earth do they do that? Well, let's find out. So first, let's really dig into that common experience of just buying and holding. It's an approach that's absolutely filled with hope, but man, it often smacks right into some pretty harsh financial realities. This is what we call the investor's dilemma.
Okay, so here's the classic disconnect between the story we tell ourselves and what actually happens. On the left, you've got all the reasons we love gold. It's a safe haven in chaos. It's a hedge against inflation, a timeless store of value. And look, there's definitely truth to that over the very long run. But on the right, that's the brutal reality for anyone trying to make money. Gold can be incredibly volatile. It produces zero, and I mean zero cash flow. The only way you profit is if someone, someday, is willing to pay more for it than you did. You are 100% dependent on price going up.
This really gets to the heart of the problem. A productive asset is something that works for you. Think about it. A rental property sends you a check every month. A great company pays you dividends from its profits. Even a simple bond pays you interest. These things are actively putting money in your pocket. Gold, on the other hand, doesn't do any of that. It just sits there. It has no earnings, no dividends, no rent. So unless you know the secret to making it productive, its value is purely based on speculation. And this quote just perfectly captures that feeling of frustration. It's the classic story. You buy some gold or silver, you catch a huge run-up, and you feel like an absolute genius. But then the market turns, and just as fast, all those gains evaporate. And you're right back where you started with nothing to show for it but a whole lot of stress. It is a financial and emotional roller coaster that can go on for years, leaving you with no actual income.
All right, so if being a passive holder, basically a speculator, is so darn frustrating, what's the alternative? This is where we have to make a huge mindset shift. We have to stop acting like a fan in the stands just hoping our team wins and start acting like the owner of the team, actively creating our own income.
And here's the secret, right here. The pros give up on trying to predict the future. It's a fool's game. They have no idea if gold will be higher or lower next month, and frankly, they don't really care. Their entire focus is on something else, collecting a steady income from the assets they already own. Just like a landlord collects rent from a building, they collect rent from their gold. This is how you make an unproductive asset productive.
So, what is this rent? In the world of finance, it's called an options premium. And please, don't let the jargon intimidate you. The concept is incredibly simple. An option is just a promise. When you sell an option, you get paid a fee, right now, up front, for making that promise. It's exactly like an insurance company collecting a premium. You might promise to sell your gold if it shoots way up, or promise to buy more if it dips down. For making that promise, you get paid cash today. That fee, that premium, is your income, and it's yours to keep, no matter what happens.
This whole idea builds into a simple, repeatable business model, a four-step cash flow cycle. Step 1. You own the asset, say a gold ETF. Step 2, you sell a promise against it using an options contract. Step 3, you immediately collect cash, that's the premium. And step 4, the best part, you just repeat the process over and over again, month after month, creating a recurring stream of cash flow from an asset that used to just sit there.
Now, I know what you're thinking. Selling promises. That sounds risky. And you know what? It can be, if you do it blindly. That's why professionals never just sell options into the void. They use a very specific set of tools designed to strictly define and control the risk on every single trade they make. These tools are called spreads.
The key here is that you are never making a naked, one-sided bet.
A spread means you are both buying one option and selling another at the same time. By doing this, you create this incredible structure that has a defined ceiling and a defined floor for your potential profit and loss. You know the absolute best-case scenario and the absolute worst-case scenario before you even click the button. No surprises.
So let's quickly break down a really common strategy you might use if you think gold is going to stay flat or maybe drift up a little. It's called a bull-put credit spread. Sounds fancy, but here's all it is. First, you sell a put option. That's your promise to buy gold if its price falls to a certain level. For making that promise, you get paid cash right away. That's a credit to your account. But to make sure you're not on the hook if gold completely crashes, you simultaneously buy another put option at an even lower price. This is your insurance policy. You pay a little bit for it, that's a debit. But here's the magic. The income you got from selling the first promise is more than the cost of your insurance. So you're left with a net credit and a position where your risk is totally 100% defined.
Okay, this brings us to what is maybe the most important concept in this entire approach. You have to understand there is always a trade-off. You're giving something up to get something else. But what you get in return is this powerful, asymmetrical advantage that really favors consistency over home runs.
This slide lays that trade-off out perfectly. On the left side, your risk is fixed. It's defined. You know, down to the penny, the absolute most you can possibly lose if you're wrong. No black swan events, no catastrophic surprises. But on the right side, your reward is also capped. You're not going to hit a speculative grand slam. Your maximum gain is simply the rent, the premium you collected up front. You are trading away that unlimited upside for a high probability trade. You are literally being paid to take on a risk that has a high mathematical chance of working in your favor.
And this is why this strategy lets you stay in the game for the long haul. A single bad trade isn't going to wipe you out, because your maximum loss is defined and it's manageable. It doesn't destroy your account, and maybe just as important, it doesn't destroy your confidence. You can take a small, defined loss, learn from it, and get right back in the game. That is the very essence of professional risk management.
So as you can probably tell by now, this is about so much more than just learning one specific trading strategy. It is a complete and total transformation in how you look at your investments and how you see your role as an investor. It's a fundamental shift in your entire mindset. So let's just recap what it truly means to become a cash flow investor. It means your main focus is on generating income, not just guessing which way the price will go. It means you're actively turning those lazy, non-productive assets into hardworking, cash-flowing machines. You start prioritizing these high-probability, consistent trades instead of chasing those lottery ticket home runs. You absolutely know your maximum risk before you even think about placing a trade. And maybe most importantly, you shift your identity from being a passive owner to an active operator of your own financial business. And that really brings us to the final thought I want to leave you with. Once you realize this is possible, once you see that you can collect rent from the things you own, it changes everything. That old model of just buying, holding, and hoping, it starts to look incredibly inefficient, doesn't it? So the real question is, why would you let your assets just sit there, doing nothing, when you could be putting them to work,